want to discuss the capital allocation process in general, and the motivation is actually coming from my memoirs. I'm writing my memoirs, and I wrote about this part. It's the section when I discuss when we started Orange Capital Partners and how we went through the fund of funds process and interviewed and all that stuff. So I'm writing that in my memoirs, and this is the first time I actually mention my memoirs in this podcast series, just to motivate this whole episode. The purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. So talking about the capital allocation process and how you raise money and then hopefully have some general ideas about it, I think is a crucial value added in this particular context. And the same applies to the memoirs. The memoirs, the working title right now is Love Story, and it's really about me and my life, but it's also hopefully an investment book, a book about investing, a book about risk, a book about money management and risk taking, and all those kinds of things, because that's really sort of that's the thread that goes through my career, at least as far as my professional career is concerned. I wouldn't call the first part of my life maybe necessarily a money management / risk taking type of episode, but definitely afterwards this is what's transpiring, and therefore that's what the purpose of the book is. But let's get back to this particular episode. So the capital allocation process is first and foremost a very, very important innovation. Everything that we live with, every institution that we institution in an economic sense, everything that we face, everything, it hasn't just been there. It's not like the people in the savannah 100,000 years ago had all these things and we just live with them in modern ways. We had to evolve from everything. It's like Andrej Karpathy once said in a tweet, if you bombard Earth with enough photons, eventually a Tesla Roadster will be emitted. And you could say the same thing about everything else. If you bombard Earth with enough photons, eventually we'll come up with a capital allocation process. We'll come up with democracy. We'll come up with novels and opera and all that kind of stuff. So everything that humans develop, every institution we have had to be developed. And some of them are good, some of them are bad. But I think the crucial part in this particular episode, I want to make two important points. One is I want to say that the capital allocation process is something that evolves. So it's not perfect, but it's the best we have, and it can be improved. That's the key. It's very Popperian. There's no such thing as a process. There's no such thing as a capital allocation process. Like, it's not like a blueprint. This is not like a Michelangelo statue where you have a bunch of stone and then you carve it out. You keep carving until the end of time. You keep improving. You replace existing institutions, existing ideas with better ideas. That's the fundamental idea of the capital allocation process, as much as it is for democracy or any other institution. So that's the one thing. And the second thing, which is more practical advice, that the capital allocation process right now, as it is, it's like an onion, and you peel the layers of the onion. In other words, what do I mean with that? I mean with that there's no such thing as you go out and raise money and you either raise money or you don't raise money. That's not how it works. It is a lot more subtle than that, in the sense that what you do is you peel the onion. So you start with layer one, and if layer one's not for you, you're going to go to layer two and layer three until you get to the layer where the capital that is meant for you is available. And what I mean with that is that capital raising is a reciprocal process. There's a certain person, let's say me, Krim Delko, when I started Orange Capital Partners with my partner Zovinar, we were what we were, and there was capital meant for us. It's not like we can somehow scratch something out of nothing and raise capital from places that just aren't meant to give us the money. What I'm trying to say here is that everybody has certain capital that's meant for them, and most of them, by the way, including us back then, it actually is friends and family. And then there's layer one, which is maybe it's for people with a reputation and they already are big names on Wall Street. They will actually that layer one is not even like the capital will look for them. And then there's layer two, layer three. It gets more and more difficult to raise money. My point is that the money is meant for certain people, and not that you can somehow raise money if you just throw enough PowerPoints and all that kind of stuff. It's not going to work. So these are really the two key points. There's a lot more in the book, and I'm still working on that particular part of the book. But that's kind of in general what I want to discuss today. This is Not Even Wrong podcast. It's February 17th, 2023. This is Krim Telco. For the day, the fund is up 4.7%. The market is down 30 basis points. For the year, we're up 71%. The market is up 6.3%. We're outperforming by 64.7%. So this is a conversation about capital allocation, and it's a more general philosophical conversation, and then hopefully also some practical advice. I'm trying to have it always, like as always in the Not Even Wrong podcast, the purpose here is to give people a sense for what it feels like to run a hedge fund. So I'm trying to thread this fine line between practical advice and also giving people a little bit more background and a little bit more meat around the bone, and even some philosophical thoughts about how this process actually works. I think both are important. And as always, this is not any kind of investment advice, so please don't take this as some sort of investment advice, and also don't take this as a solicitation for our own fund. So what I talk about in my memoirs about the capital allocation process is that it's like an onion. So raising capital as a hedge fund manager, as a prospective hedge fund manager. So you have some idea of what you want to do. Let's say in my case, when we started at Orange Capital Partners, when we founded the company, me and my partner Zovinar, we've had together 30, 40 years, I don't know the exact, maybe 30 years of experience in actually running money at risk, meaning not just, managing money for some sort of pension fund, but actually having discretionary power to invest money at our own discretion, and therefore taking risk and being measured by that. So, but we haven't done it in our own fund, and therefore we didn't have our own audited track record. What we had is, we had reputation, we had a resume, we were employed by people, we had, of course, people could check, the typical stuff. You could get a reference from my old boss and all that kind of stuff. So we were at that stage, and now we were ready to go and raise money. And what we did, we went to fund of funds, which back then we're talking 2007, 8 time frame. That was the thing to do. I don't know the exact process today. I think it's similar, but let's not talk about today. Let's just talk about my experience back then, because that's what I know really best. So what we went to is a fund of fund. What is a fund of fund? It's a fund that raises money from other people and then allocates it to hedge fund managers. So that's what the fund of fund does. And I talk about this in my memoirs because it might sound a little absurd or even crazy. Why is there such a thing? And I go way back to the sort of history of capital allocation, and I ask myself the question, why do we have these institutions? And I think first and foremost, I have to admit, it's a great invention, right? It's an invention because what is actually capitalism all about? What is trading, capitalism, and all this idea that we have, this free market stuff all about? Well, it is about doing business in a trustless form with third parties. That's what it's all about. The more we can do of that, the better. What does that mean? That means that if we go way back, business was done through kinship, right? Because you had to solve for trust. And what happened, and I think that was a big innovation in the early Renaissance, was the rise of the banking houses. And what were banking houses? Banking houses were intermediaries. So financial intermediaries are solving for trust. They're solving for the Byzantine generals problem, to use a computer science term, which can be applied here. It's just simply, look, if I send cloth from Florence, Italy to Augsburg, Germany, how am I sure? How do I know that the person I deal with is real, that they're going to pay me? How does the person in Augsburg know that I'm a real person, that my cloth making is real, and all of that stuff? And of course, we have things like brands and reputation. But what we need is a financial intermediary to make that trade trustless. So that means, look, I have two options to do that. I can only trade with people I trust. And even today, people say, I only trade with people whose handshake I trust and blah, 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 blah. or I use financial intermediaries. And of course, in modern capitalism, when trade flows are complex, when you have companies like Tesla or Amazon with 100,000 employees, how can you do business in a not trustless form? Like, you have to do it in a trustless form because you don't know if everybody's going to do the right due diligence. So what you do is you use banks, you use all that kind of stuff. So this is where capital allocation started. Now, I use banks and financial intermediaries because they were enabling trustless trade. Trustless trade is my Augsburg example, but you could apply the same thing a couple years later, maybe a century later, after the early Renaissance invented or reinvented, to be fair, the banking and the financial intermediary, because similar ideas were also propagating in the Roman Empire, and that's why it's called Renaissance. It's the rebirth of the ancient Roman and Greek cultures. So what we have is the invention of contract law and accounting and all of that kind of stuff, and now we have the invention of the stock market in 1602 in Amsterdam, which is another big invention. The particulars around the stock market are two. One is the limited liability company, and the other is, of course, the publicly listed shares. And what we have now, of course, sooner or later, we're going to have a financial intermediary that helps people invest in those shares. And since we're only talking about the Amsterdam Stock Exchange in 1602, what is going on is there's only one company, which is the Dutch East India Company. So there isn't that much, maybe due diligence necessary. What I'm saying here is you might not have the emergence of, let's say, investment professionals yet, but you can easily extrapolate this now to many more companies and many more stock markets around the world and global and this and that. So what you have is the same problem. You have a person that has money or saved money. She saved money and now she wants to invest that money. I mean, this is what we're talking about here. And how can she do that? Well, she can go and check all the companies and do all the due diligence necessary, or she can entrust it to financial intermediaries. And that's what's happening in the stock market. I would say that's really what's going on in today's stock market. And that's what financial intermediaries and capital allocations and all of that kind of stuff is. So this is sort of where I come from. I'm trying to explain why this process is the way it is. And I think it's important to note that even though these processes might seem cumbersome in today's, they might seem cumbersome in the sense that, oh my gosh, I want to start my own hedge fund, and now I have to go and talk to a fund of funds, but it's the best process we have. And if we have a better process, then go get it. I mean, there's nothing wrong with having a better process. But this is, right now, as we speak, the best process we have. I think this is an important point. It might be subtle. Most people might say, so what? What I'm trying to say here is that, look, we have an evolution of processes in terms of a capital allocation. It started all the way back down in the early Renaissance, and it evolved until today. And we can improve on that. And this particular episode now is not meant to offer, let's say, suggestions for improvement or anything like that. That's not the point here. I mean, I can just tangentially mention, of course, the Bitcoin blockchain or any other public blockchains that could be a solution for the Byzantine generals problem, and therefore help trustless trade amongst third parties. That's one option where we could go, and then we could have an explosion of trade and commerce around those things. I think that warrants its own episode. But what I'm trying to say here is simply that the process of capital allocation, the way we have it today, it is an evolution, and it's better than what we had before, and it helps people like us and many other people to raise money. Now, for us, and this is the second point I want to make, it was the onion. We peeled the onion, and the onion is, let's say, the layers of easiness to raise money, and it depends on who you are. So money is not a black and white thing that you go there and you raise money. Like, it depends who you are. Some people, they raise money from layer one. Layer one would be the easy part, where the money actually looks for you because you have such a good reputation that they want to give you money. Layer two, your reputation is okay, but it could be better, and so on and so forth. Now, we ended up where most people end up, which is friends and family. And friends and family is just another word for, again, trust, right? It's all about trust. Like, nobody trusts me. I'm not worthy in institutional money. So what can I do? I go to people that trust me, that want to help me, either because they love me or because they trust me, or right? That's really what's going on. And that's where we ended up. Friends and family. There's nothing wrong with friends and family. Most hedge funds, most companies for that matter, they start with friends and family. This applies to the venture capital startup community, by the way. It's the same concept. The idea is that you have friends and family that are the first layer of investors that are meant for you. They're meant for startups. They're meant for startups that haven't proven themselves, that haven't been able to build a reputation or a track record or anything like that. And that's where you end up. So there's nothing wrong with that. And I think it's important for prospective hedge fund managers to understand that. You start with the onion, and it's okay even if you don't have a lot of prospects, let's say, to raise money from a fund of funds, or if you're in the friends and family layer. It is still okay to give it a shot, to do your PowerPoint, to go and do the presentation, because you learn a lot. I would say that this Not Even Wrong podcast series is actually it's just another way for me to continuously be in that process of reflecting upon my own career and professionalism, and why am I doing what I'm doing, and what are we doing, and all these questions, because we want to be how should I say that? We want to be always en courant, on sort of in real time, reflect on what we're doing, what our strategies are. That's why we discuss, investment ideas. We discuss positions and trading. And again, this is not trading advice. The purpose is to give our listeners a sense for how they feel like to run a hedge fund, and of course, also it is meant for our own purposes. So what I'm trying to say here is go out there and try to raise money on every layer of the onion you can go. There's nothing wrong with that, because it makes you better, it makes you stronger. Challenge yourself, and even if you fail, raising money is also, it's the process of many no's, but you're going to eventually get somewhere. And everybody finds capital is meant for them. It might not be the amount of capital that you're looking for, but you can start a hedge fund with $1 million. You can start a hedge fund with $100,000. Now, there's a certain minimum, of course, but that minimum is very low. And it's not hundreds of millions of dollars. And you don't need a CFO and a COO and all that kind of stuff to actually raise money. To start a hedge fund. So to summarize, this is the first time we're mentioning my memoirs here, and the book's still in writing, so there's nothing to market here or anything like that. The point here is what we're trying to do is, in this podcast series, give people a sense of what it feels like to run a hedge fund. And in the memoirs, I'm discussing the capital allocation process within the context of when we start Orange Capital Partners, and I'm discussing our process. And there's two big takeaways that I'm writing about in the book, and that I want to share here in this podcast episode. And one is that raising money is like an onion. It's not black and white. It is different layers, and you're going to have to go through all those layers until you find the capital that is meant for you. And everybody will find capital somewhere. Most of us end up with friends and family, but that's okay. And then start with whatever you have. And I think second, and also very important, is that the capital allocation process, like every other human institution, it evolved. It evolved over millions of years, thousands of years with humans. It's like the law, like democracy, ethics, morals, all of these things evolve. It's very Popperian. And there's no such thing as a perfect capital allocation process. What we're trying to do is replace the existing ones with better ones. And then maybe, blockchain technology could be one of those better ideas. But most importantly, again, as a prospective hedge fund manager, don't go out there. Don't be frustrated about it. It's a frustrating process. It's supposed to be frustrating because we don't know which layer in this capital allocation process we are. And we don't know if we might be, we have to find that out. And the only way we find out is with try and error. And like everything else in life, we do try and error, we fail, but we make an effort, and we will find the right. We will carve that situation for ourselves out that works for us, and then keep going, and then you will end up in a good place eventually. Thank you.